Okay, we are live. Welcome to Boston Basic Income. This week's topic is the Weimar Republic hyperinflation. So hyperinflation in Germany in the early 1920s after World War I. So some of us read an article by George Goodman. Well, actually, it's an excerpt from his 1981 book, Paper Money. He was writing under the pseudonym Adam Smith for obvious and probably egotistical reasons. But yeah, it's got a basic kind of overview of what happened back then. And for the discussion today, what I want to get into is, did that have to happen? You're in a situation where Germany has to pay reparations post World War I. If you're in a situation, if you're a country and you have a currency and you're in a situation where you have to make a payment or you have to pay a debt that's unpayable, what are the possible outcomes of that? Does hyperinflation have to happen? Does a default have to happen? Does a restructuring have to happen? That kind of thing. And then the German hyperinflation is often brought up in the context of discussions about basic income, because people say, well, you can't just hand everyone free money because that will cause hyperinflation or something like that. So to what extent is that true? Are there any conditions under which a basic income, designed in a particular way would cause hyperinflation? What if there had been a basic income in Germany in the 1920s? Could that have been part of maybe making things not as bad? Was there anything that Germany could have done to prevent things from going the way they did? And we can also look at how they got out of it in the end. Could they have done something like that sooner? So with that, I want to go around the room and get people's initial thoughts. You can pass if you want. So just initial thoughts on the Weimar Republic hyperinflation of the 1920s as it relates to basic income or not, or how basic income relates to hyperinflation. So we will go around. We'll start with Martin, and then we'll go to Richard, and then we'll go to Jake.
So my first thought on the article was that the psychological element that may have been at work. And I lived in Germany in the mid 80s, so a little bit after the article or the work was written. And I experienced a change in the dollar to Deutschmark, and I won't go into all of it now, except to say that when I lived there, when I watched what happened, there was very much a psychological element that seemed to be part of the value of the Deutschmark versus the dollar that was not attached to some sort of fundamental economics. It was a lot of perception and psychology, and we'll can discuss that more, I guess, as we talk about the article.
Okay, let's go to Richard, Jake, and then Bethany.
Well, the whole desire for reparations was, well, unfair, because there's no way you can pay that back. And if your country's been bombed out or whatever, and why should you pay back what the other people their expenses for the war? That's just, and especially when you're the loser and you don't have any real way to do anything. And that's one of the reasons why that Germany was, well, sort of forced towards fascism, and that caused a whole problem down the line, like 20 years or 17 years or whatever.
Okay, I just want to point out that Germany was not bombed out after World War I. Most of the fighting did not take place on German soil. The fronts were in France to the west, and I think Poland to the east, and so it wasn't. Their infrastructure, their industrial infrastructure, was pretty much intact after World War I, unlike World War II. So that's an interesting thing to pay attention to. So they had hyperinflation even though their infrastructure was intact, and some of that infrastructure obviously got taken away when France invaded the Ruhr Industrial Valley and that kind of stuff. So there's a little more nuance there too, but it's interesting. It's interesting to pay attention to. Let's go to Jake, and then Bethany, and then Dan.
Sure. So I guess, admittedly, I didn't read this article. I'm just browsing it, like perusing it right now. But I guess just one little comment is, like, I guess in the 1920s when this happened, like the U.S. dollar was the global reserve, right?
I think at that time it was still the pound sterling,
sort of.
and maybe that shift was starting to take place as a result of World War I, because the United States ended up with all the gold after World War I. So it was kind of in that transition period, but I think most people were still thinking of the pound sterling as the world reserve currency.
Okay, I guess I'm just thinking like, I mean, I guess this kind of hyperinflation thing can happen. You know, there's examples of it happening to currencies that haven't been the reserve currency. But like, at least like in just like I don't know, I haven't really seen an example of a time where like something that's like, you know, the global reserve where they see hyperinflation in that currency. So I guess even though I haven't read it, that's kind of one thing that I'm thinking about is like, all right, fine, it happened in Germany. It could happen anywhere that's not, you know, that does some funky stuff, printing too much money. But would it happen if, you know, if America did it, for example? Like, and I think, yeah, I'm still not convinced that like just printing a bunch of money, you know, 10 trillion, whatever, like is going to lead to hyperinflation, because we've got a different like place in the whole like global system than anyone else who's not a reserve currency does.
Okay, that's an interesting thought. Yeah, and I think we'll get into that in the discussion. Let's go to Bethany and then Dan.
Hey, so I really liked the article. I'd like to think a little bit more about why the hyperinflation happened, since it does seem like Germany was still a decently productive and prosperous country. So it wasn't clear to me if it was just that the reparations they had to pay were really, really high, or they just mismanaged the monetary policy. But in terms of your question of whether it had to happen, my sense is that no, there could have been ways for them to keep the currency in check. It's not clear to me that there's no reason I see like automatically why that wouldn't have been possible. So I'm interested in why they didn't do that. A couple other things I noticed, and I know not everyone read the article, but Martin also mentioned there were like a lot of really interesting social consequences to inflation, which I hadn't thought as much about in terms of people shifting their sense of the value of like saving or preparing for the future, or their trust in institutions. It's interesting to me that Germany still is thought of as having really high trust in institutions. So they like clearly recovered from this also, which is interesting because it sounds like it hit some pretty bad lows. So I guess I'm interested in maybe they actually did compensate people eventually, or kind of, it's interesting how they might have recovered from it socially, in addition to like the recovery of the currency. And the last thing I noticed is that the industries had an incentive in the short term for the inflation, which I think must have been a pretty like short-sighted incentive. But that's what the article claimed, is that like they kind of liked that the German goods were cheap because they could export them more easily. And so like that maybe was one of the problems in terms of why the government let the inflation go on, is that the industries were kind of seemingly somewhat in favor of it, at least in its milder form. So that's something we could talk about. And that also relates to jobs, which is something we talk a lot about here, that they wanted people to be able to keep their jobs in those industries. So that might have fueled the inflation too. So different things to talk about.
Yeah, good stuff. Go ahead, Dan.
Yeah, just a quick response to that, the trust in institutions piece. I think part of that might have been because the hyperinflation didn't occur as a result of corruption by the government, because there's examples of that happening, like Yugoslavia in the 90s. And so that might change that kind of dynamic. And related to that, one of the interesting things from the article for me was, and kind of related to what Martin said about the psychology, just how much sort of political stability also plays a role in, you know, how people value the currency, which, you know, has a relationship to hyperinflation. I did not know that piece about the foreign minister, which I guess would be like the Secretary of State, being assassinated, and how that might have shaken people's confidence in the long-term viability of the Weimar Republic at the time. So that was interesting. And then I guess just another thought about basic income. I don't think basic income is likely to lead to hyperinflation. Certainly some inflation, but I mean, obviously anything, if totally mismanaged, would probably lead to hyperinflation, but I think any kind of reasonable basic income distribution would not lead to hyperinflation, because I think the baseline definition of hyperinflation is like a 50% increase in the price level in a month. So if you're just going by straight, you know, definitional perspective, then I don't know how basic income would lead to that level of inflation. So yeah, so those are my initial thoughts.
Yeah, it's kind of an arbitrary line where they draw like what counts as hyperinflation and what doesn't. But I think there are some qualitative differences between kind of the hyperinflationary mechanism and maybe what you would see with normal inflation. So, for example, it's kind of like this runaway feedback loop that can't be stopped. There are countries that have had inflation, in inflationary periods, and then they come back from it, and it's fine. And then a lot of the standard monetary policy is to have like 2% inflation every year, and that's just like the target. That's what they're trying to achieve with price stability. So hyperinflation is something else. It's kind of this out of control process. And I think I can tell you right away how you could use basic income to cause a hyperinflationary cycle. So all you have to do is look at the productive capacity of your country, and then say, I want consumer purchasing power, their real purchasing power, to be higher than what the economy can actually produce. And I'm going to index basic income to inflation. So as the prices go up, I'm promising to increase the basic income to match. And so basically there you're making a commitment where no matter how high the prices go, you're going to raise them further. And it's kind of like this exponential process. You're committing to something in terms of your real economy that's actually unachievable. And you're promising to keep spending money into the economy to achieve this unachievable thing. And I think that's kind of the common theme with all hyperinflations. So I just gave you an example of how you could do it with basic income. But in the particular case of Germany, like Bethany mentioned that maybe it didn't have to happen. Maybe there didn't have to be hyperinflation. Maybe they could have gotten under control, that kind of thing. Well, you're in a situation where you've just lost World War I, and France and the other allies are making you commit to pay these reparations out to the other to the allies, to the winners of the war. And these reparations are not in your own currency, so it can't just be like, oh, it's 1 trillion Deutschmarks, and you'll spend those and then your debt is going to be paid. No, it's denominated in gold. So you're making, just like I was saying with the basic income example, you're making a real commitment, to provide a certain amount of real stuff, and you have to buy that stuff. And maybe it's more than what your economy can do. Yeah, go ahead, Dan.
Yeah, so I think I've read that the economist Michael Hudson has said that the Allies could have just forgiven the debt. That would have been one way to not have this happen, which I think is a reasonable, idea.
Yeah, and I think that's a great point. Like after World War II, we took a very, very different approach, and we said, oh, these countries lost this war. Now we need to help them get back on their feet. Obviously, not in a way that lets them fight us again, hopefully, but it's not about pushing them down even further. But I think it's also true that it was very difficult for the Allies to forgive the debt because they had gone into debt too, especially France. Well, actually, France was owed a lot of money from Russia. But then you had the October Revolution in 1918 in Russia, right at the end of World War I, where suddenly now you have a new regime in Russia, and they're not going to pay the debt to France. So France was feeling very squeezed because they had this debt coming to them that wasn't being paid, and they owed money to like the UK and the United States. The US was kind of like in the best position. Everyone owed money to the United States, and the United States didn't owe anyone any money after World War I. But France was kind of in a bind. So a lot of people were critical of France, and a lot of the other countries were critical of France for putting this pressure on Germany. But in a sense, France also was under pressure and didn't really have a choice. So it's you can say like, oh well, you can just forgive the debt, but then you're kind of coming up against your own constraints as well. So that can be problematic. Go ahead, Bethany.
Yeah, I guess I just wanted us to speak a little bit more to what Germany might have been able to do to avoid it, or was it avoidable? Like, I don't know the level of reparations like relative to their economy, but it seems like they still had a productive economy. So what should they have done is kind of like my question to you or to other people to prevent happening.
So it's certainly true that they didn't do everything they could have done. They didn't do the best they could have done. And you could ask I mean, I think it's probably true that even if they had done the best they could have done, they still wouldn't have been able to pay the reparations. Eventually, part of how they got out of it was that a lot of the reparations debt was forgiven. That was a huge part of how they were able to move on from it. Or restructured, I guess is how they say it. But there are some things that they clearly did wrong. One of them, so France liked to say that, Germany would say, we can't pay this much debt. It's just, we can't do it. It's not doable. And then France would say, we don't believe you. We think you're holding back on the payments, and we're going to enforce this. And then France and Belgium invaded the kind of this industrial area of Germany, the Ruhr Valley, and basically took it over. We're going to take over your productive capacity because we know you have it, and we want to extract our reparations in actual production from your factories, et cetera. So they did that, but then the German government told all of the workers there to, do this kind of passive, protest. Don't go to work. Don't, work for the French, that kind of thing. So that actually kind of shut down the productive capacity that France was trying to extract. But another thing that happened at the same time was the German government was still paying all these workers. They were paying them not to go to work. So you've got kind of inflationary pressure from both sides of that. So that didn't necessarily need to happen. That was like political. Germany was feeling injured and upset, and they were trying to protest and get out from under this. If you're put into that position, it's not necessarily true that there's an easy way out. Like if they hadn't protested, then maybe France would have extracted a little bit more, but Germany would have ended up in a similar situation or something like that. Another thing that Germany did that maybe wasn't optimal was that so the way, when we say printing money, what they actually did was they were issuing bonds onto the market. So they were borrowing from the market, but these bonds had a fixed 5% interest rate on them. So they'd announce, a number of bonds. And this is kind of how it used to be when governments issued debt. It's not how it works anymore. But they'd announce the interest rate, and then they'd say, if you want to buy it, you can buy it. And then some people would buy it, but you wouldn't get subscription to all, they call it subscribing to the debt. You wouldn't get subscription to all of the debt. So then the Reichsbank, the German central bank, would pick up the slack, and they would buy the excess debt at 5%. So something, if this were a modern situation in a modern country, typically what governments do is they auction off the debt. So the interest rate is not fixed ahead of time. They auction it off so that the interest rate is set by the market. So if they had done that, then maybe the interest rates would have been a lot higher, but they would have sold all the debt onto the market. And then a consequence of this is that with the higher interest rates, you've got tighter monetary policy. It gets harder to borrow in the German economy. So that can kind of rein in the monetary conditions in the country and provide some pushback against any inflationary pressure. So they could have done that better, but again, how far would that have got them? They might have been able to pay back more of the reparations. It also would have been bad for business in Germany, and they were very concerned with keeping everybody employed. They wanted the economy to be kind of stimulated, and they wanted the jobs to stay around. So this kind of gets to my third point, which is, what if they had had a basic income and they didn't care about jobs? What if instead of keeping the industry going, they say, okay, we're going to fund consumers at a very low level. We're going to allow the financial sector to contract. We're going to allow the currency to contract. And, everyone's going to be poorer. Obviously, that kind of had to happen. We lost this war, we're paying these reparations. Everyone's going to be poorer, but nobody's going to be, below a certain level. Nobody's going to, there's no, you're unemployed and then everything is, falling apart. No, everybody's a little bit poorer. So I feel like if they had something like basic income in their mind, they might have been able to pay a small amount, and that would have allowed them to tighten their monetary policy and issue the bonds at a higher interest rate, or even auction them off if they're thinking in modern terms. Go ahead, Bethany.
Just, I guess, to clarify a little bit more, instead, can you walk us through how the hyperinflationary spiral kind of happened? Because I feel like I still don't have that kind of crisp, and maybe other people don't either.
Yeah, so it happened in stages. I would say that probably it was only really hyperinflation in 1923. So during World War I, pretty much everyone except the United States went off the gold standard. So the gold, keeping yourself pegged to gold is kind of this disciplining force, but everyone needed to spend in order to you know, get resources for the war. And then, you know, some of the people who did that lost the war in the end. So there was a lot of, you know, Germany thought the war was going to be very short. They funded their war effort through borrowing, and they were just borrowing more and more and more and more. And then when the war was over, they had to figure out how to maybe pay back that debt or figure out what to do with that. Their plan was to pay it back by imposing reparations on the Allies, right? Like the Allies imposed on them afterwards. So it ended up being you know, not working out that way. And if you have both sides funding their war efforts in this way and planning to extract and pay back their own debt from the losers, then you're going to run into these problems. So that was the start of it, but it wasn't that. That was just the beginning. So that kind of set the stage. Your currency is no longer pegged to gold, and you have you know, prices that are maybe you know, multiples of what they were before the war. That's not hyperinflation yet. You can probably sustain that. And then what happened was the Treaty of Versailles, where Germany was made to pay reparations in money that they couldn't print, right? So now you're in a situation kind of like what I was saying before with basic income, where if you commit to more than what your economy can produce, then you have no choice but to either default or go into hyperinflation or restructure the debt. So Germany restructured the debt and went into hyperinflation. First they went into hyperinflation, then they restructured the debt. But that, you know, even the Treaty of Versailles, that's what, 1919 or something like that. And the hyperinflation didn't really kick in in full force until 1923. So there were some things that were happening in Germany. Like the stock market was very strong. So people would, you know, all this money was being printed, but then it was going into the stock market, and you know, there was foreign investment coming in too. So there was foreign gold, you know, and other currencies coming into the economy and propping up the stocks. It wasn't that the money had nowhere to go. There was kind of a tipping point in 1922, 1923, where people started to become uncomfortable with the level of inflation in Germany, and then the flows started going in the opposite direction. People were getting their money out of Germany. And then that's when the hyperinflation really kicked into gear. And it was really like in January of 1923 is when France said, no, we don't believe you. We think you're holding back. We're going to invade your Ruhr industrial Valley and take over that area. And they were in there for, I don't know, a couple of years. So it wasn't just like this temporary thing. They were in there. They took away a lot of Germany's productive capacity, and Germany intentionally shut down that capacity so France couldn't use it. And they printed money as an incentive for people not to work at that time. So kind of all of these things together combined and created this hyperinflationary situation. Does that make sense?
Kind of. So they had to pay the reparations in gold or in something tangible, but I guess they were printing the money for other purposes in their economy. Like
they were printing money for other purposes. They were also printing the money to buy gold.
Oh, to buy the gold. I see.
Exactly. Yeah. Yeah.
Okay, cool. And then they just kept on doing that more and more as things got more expensive, presumably. Like they kept printing more. It seems like that's where they could have run things.
And there were also arguments that because the prices were going up, it's kind of this positive feedback loop. Because the prices are going up, people need more money to be able to pay the prices in the economy. Yep. And then when you give people more money, that causes the prices to go up further. So it's this self-reinforcing thing. Yep. Yeah. Go ahead, Dan.
Yeah, I just wanted to ask if you know this, Alex, because it wasn't clear in the article how the Rentenmark was introduced that replaced the mark. It just kind of said like this guy was like a financial wizard or something, and this they cut 9 zeros off. And I was thinking that is basic income a way to replace a currency in a situation of hyperinflation, heavy devaluation of a currency? Is a basic income a way to help introduce a new currency into a country?
Yeah, I think it could be. The way they introduced the Rentenmark was they had this new currency that was backed basically by mortgages and industry, so industrial bonds and stuff like that. So it wasn't directly backed by gold, but it had something you could trade it for, a share in a mortgage and that kind of thing. And Germany had land; they had good land, so it was kind of like using that land as collateral for the currency. And I think, at the same time, there was restructuring of the German debt. So it became something that was no longer unpayable. They still had to pay some amount, but it was not as much. So that kind of took some of the pressure off. It created the conditions. First, they created the conditions where they could have a stable currency, and then they had to get rid of the old currency and install something new. And that was the Rentenmark.
Okay. But I understand the bond piece, but how did the currency actually get to like all of us? Like how did people actually get access to it? Did they buy?
Yeah.
They just traded?
Yeah. So the way it worked was that you could trade in a certain number of your old currency for the new currency. So people just cashed in, and it was like $1 trillion or something like that of the old marks for the new mark or something. Yeah. So it's just kind of a swapping out. And if you're interested in this kind of thing, I would encourage you. There's a Planet Money episode about how they addressed inflation in Brazil in the 1990s. That's really fascinating. And it wasn't really hyperinflation, but it was high inflation in Brazil, and they wanted to get it under control. And the way they did it was first by creating a new currency unit. So that, its value would be adjusted based on, how much inflation there was in the real, right? And so the prices that you'd see on the shelves would be in this new unit, but then you'd take your old currency out and pay whatever the exchange rate happened to be that day. So they did that for a while, and then they started issuing tokens that were denominated in the new unit. And of course, then they started having to manage the flow of those tokens so as not to prevent inflation in that token as well. But that's kind of how they transitioned to a new currency. And I like that story. It's a really great episode if you want to listen to it. Yeah.
Okay, cool, thanks.
Yeah, so let's get to the article. Here we go. Where is it? There it is. Actually, let me hold on a second. Okay. In retrospect, you can trace the steps to hyperinflation, but some of the reasons remain cloudy. Germany abandoned the gold backing of its currency in 1914. The war was expected to be short, so it was financed by government borrowing, not by savings and taxation. In Germany, prices doubled between 1914 and 1919. So this was kind of the first step, the removal from the backing of the gold standard. And it's an interesting point, because if you are on a gold standard and you're holding that peg, there's only so much you can do. You at some point you run out of gold, you run out of money to spend. Whereas here you don't. Now, I think it's true that if you're pegged to gold, then gold isn't the thing that people normally need to buy in the economy. So it's not going to be necessarily the most stable possible currency, but it does have this kind of disciplining effect. If you are pegged instead to a basket of consumer goods, like you're trying to keep your price level stable, like we do today, then you can have a much more efficient currency. But it's also perhaps easier to say, I'm going to, spend more than the economy can handle and inflate away a little bit of it. And that way it's kind of like a tax, even though it's not, I'm not officially taxing anyone, but, by spending more money, I'm kind of devaluing everyone else's money and that kind of thing. It's a way to kind of slip a tax under the radar. So yeah, that's something to think about. Go ahead, Bethany.
Yeah, so I was wondering, like, what if had been on the gold standard then, because we've just kind of talked about how they didn't really have very many options in terms of paying back this debt that they couldn't pay back.
Yeah.
So still just have their hands and default on the debt.
Sorry, I missed some of that. You're breaking up a little bit. Could they have just defaulted on the debt, you're asking? Nope. I think we lost Bethany, at least temporarily. Yeah, so I mean, I think, could they have just defaulted on the debt? I think they didn't really have an option to just, oh, Bethany's back, okay. They didn't really have an option to just default on the debt because then they would have been invaded by France even perhaps earlier and more forcefully and that kind of thing. So they at least had to make like they were going to pay it back. And they had to complain that they couldn't do it, but they couldn't ever just say, no, we're not going to do it. We're not going to pay back the debt, because then France would say, oh, but you can, they would have at least pointed to some of the things that Germany did do, like printing all the money to buy the gold and that kind of thing.
But what I was asking is, like, if they'd been on the gold standard, I don't know if you heard me say that, like, what would their options have been at that point?
I mean, their options would have been similar to when you're going to war and you're on the gold standard. The first step is to leave the gold standard.
I see. Yeah. So it's not exactly like leaving the gold standard was really the root of the problem here, because if they had been on the gold standard, they would have had to leave it or something anyway. I guess that was kind of my point. It seems like the reparations were the root of the problem.
To some extent, you can use that as an excuse. You can say, hey, gold standard, we just don't have the money, right? There's like a point before you break off the gold standard where you can kind of use that as an excuse not to pay. You can say, like, well, this is, like, there's nothing we can do, gold standard, right? And for a lot of things that were smaller, countries would do that. So if you're England in the 1800s and, there's, a drain on your gold going to foreign countries or something like that, you're like, you know what, we got to raise interest rates, otherwise we're going to lose all our gold. And then, that kind of contracts the economy, but it's like, hey, we got to do it, gold standard, nothing we can do. Yeah.
Right. So they might have had more of an excuse to do that kind of tighter monetary policy.
Yeah. My sense is that they would have ended up having to leave the gold standard or do something, and they would have been forced off. Like if the pressure becomes too great, you get forced off the gold standard, and that had already happened, of course, in World War I. I don't think this book that we read, or the excerpt that we read, is from a book called Paper Money, and the guy who wrote it is very much kind of like pro gold standard, anti-fiat money kind of thing. And I think he's thinking about it as like, okay, this was the first mistake that Germany made, was going off the gold standard, and you should expect once you do that, everything falls apart or something like that. I don't think that's right. I think they were kind of forced off the gold standard, and they were forced to pay the reparations, and it wasn't really. And it's not like leaving the gold standard. Yeah, there is some disciplining force there, but it's not. It's not gonna, the gold standard, it's not like this thing that you stick to it and it kind of like makes your currency stable and solves all your problems. In fact, what we saw during World War I was everybody left the gold standard except the United States. So all the gold flowed into the United States, and then the United States had inflation because there was so much gold, right? There's so much gold floating around that all your prices go up. So that was, so gold isn't really kind of like this perfect stable thing that you can peg your currency to, and it depends on how many other people are pegging to gold, and how much gold is available, and how much do people want gold, and like that kind of stuff. Yeah. So let's get to another quote here. Under the Treaty of Versailles, Germany was forced to make reparations in gold-backed marks, and it was due to lose part of the production of the Ruhr and the province of Upper Silesia. The Weimar Republic was politically fragile. So I think the political fragility is an interesting point. So there was an attempted, communist revolution right after World War I, and then there were a lot of people who felt, especially on the right, who felt that Germany should never have surrendered World War I. There was a kind of a revolution in Germany where they, ousted the Kaiser and everything like that. And then the next day, the new government said, okay, we surrender, right? And then there were a lot of people in Germany who were very upset about that. They thought they never should have surrendered, and they called it, the crime of 1918 or something like that. Or the December, I don't know what it was called, but they very much felt that way. So there was a lot of political pressure not to kind of acquiesce to the Versailles Treaty, even though it was kind of extreme what they were asking for. There were a lot of people who said, there should be no treaty. We should be still fighting the war and winning the war and that kind of thing. So that made it very difficult too. And in terms of losing, so in the Treaty of Versailles, Germany did have to give up a lot of territory, including part of the Ruhr Valley as well, not the part that France and Belgium invaded later, but it was, it was significant. So yeah, I don't know if there's much more I have to say about this particular quote. We can go on to the next one unless anyone has any comments. Yeah, go ahead, Dan.
Yeah, I just had a question I was thinking about too. It seems like when we're talking about if Germany could have avoided this, or if they could have made different decisions, it seems like a lot of the things they did was to ensure that their citizens wouldn't be poor, which I think is something that's going on right now around the world in relationship to the coronavirus, with what governments and banks are doing, central banks are doing. And so I guess my question is is hyperinflation worse than hyperdeflation, which is like, are you trying to always avoid deflation at all costs? That seems to be the conventional wisdom. And to some degree, I think that's right. I think modest inflation is probably better long-term than modest deflation. But is it, because it seems like if Germany let its country become poor, which it could have done, I mean, you obviously have political instability that probably would have arose out of that, but probably likely economically you would have had massive deflation. And so do you have any insight as to if they were thinking that was something to avoid at the time?
I don't think they were trying to avoid deflation per se. And the Great Depression hadn't happened yet. I think when the Great Depression happened, everyone started to take deflation a lot more seriously. I think if you have hyper in either direction, it's probably really bad for all your people. I think, is a little bit of inflation maybe a little bit safer than a little bit of deflation? Maybe. I liked what you said about, they didn't want their citizens to be poor. And the way they were thinking about it back then was in terms of jobs. And that's still the way we think about it, today in America. And we could ask the question, if they weren't thinking in terms of jobs, if they were just thinking in terms of, we know we have to pay these reparations and we know we're going to be poor, let's just admit it, but also, provide maybe a very low level basic income to our citizens instead of trying to, create and protect all these jobs, then would they have had a more stable outcome? Maybe, or maybe they could have paid a little bit more of the reparations before they hit rock bottom, right? So the question is, would France have ever let up without getting the full reparations paid back? And the answer is probably that either they were never going to let up, or they were going to let up when Germany hit rock bottom, and Germany hit rock bottom. So the rest of it might just be kind of rearranging deck chairs on the Titanic or something like that. Maybe you get a more optimal configuration, but the ship is going down and France is the iceberg that's taking you down or something like that. Yeah.
Always France.
It's always France. Well, it's France was in a bind too. They were being squeezed from what they owed and what they weren't getting paid from Russia. So it was a very difficult situation for them. Let's go to Austin.
Hey guys, I have a couple of questions really quickly, going back to the sort of understanding the situation to start with. Firstly, about sort of how the debts were denominated, and not just the German one, but the one of France to the United States and stuff. Were all of these somehow tied to gold, and how does that work if the Germans had taken their currency off gold? And also, how exactly the stock market bubble in Germany sort of played into it? Because I'm just sort of still having trouble putting all the pieces together in my head.
Yeah, so Germany definitely took their currency off gold in World War I, during World War I, but the debts were denominated in gold or foreign currencies that were pegged to gold. So it's as if they have basically debt in a foreign currency that they can't issue. So that's kind of how the debt was structured. The stock market factored in partly because Germany was issuing government debt at such a low interest rate, at 5%, that it was really, really cheap to borrow in the German economy. So you could borrow and then buy a stock and and all of this money could be flowing into the stock market. All this money coming in from outside was basically happening through 1922. So all of that money that was being printed or issued by the German government kind of had somewhere to go. It went into the stock market until people started to feel uncomfortable with how much inflation was going on in Germany and the situation in the Ruhr Valley with France taking over there. Then the flows reversed and the money started going the other direction. I don't know if you were here when I was mentioning that earlier, but then now you've got all these excess marks that don't have anywhere to go. There's no profitable stock market investment that you can put them into. So what you do is you try to buy real assets like pianos and things like that. And everyone just tried to unload and get things that actually were real things that had value, not the stock market anymore, but actual stuff.
So a couple of quick questions following up from that. So what they were doing is they're printing money to either buy francs or US dollars or actual gold or whatever. And secondly, when you talk about that, with the banks lending really, the government creating really cheap debt, and people using that to blow up the stock market or inflate the stock market, is there a worrying parallel with what's happening now in the US, where you have this super low interest rates and a really high stock market?
I don't think there's a parallel in the sense of we're in danger of hyperinflation. I think there's a parallel in the sense of when we start tightening monetary policy, the stock market might crash. So that's certainly a parallel. I think when it comes down to it, we're not in a position. The United States is not in a position where we have these external debts that we have to pay that are in real terms. So we're not in a position where we have to commit to doing something that our economy cannot sustain.
Rather than buying pianos, people will hold on to the liquidity. They'll hold on to the cash, is what happened when the stock market crashes.
Well, yeah, and it's also true that we have plenty of room to tighten monetary policy. And maybe you could end up in a situation where we're afraid to tighten monetary policy, kind of how Germany was afraid to tighten monetary policy. But I think we're a few steps away from that, and there's nothing that's kind of forcing us to do that, if that makes any sense.
Sorry, one more thing. Dan raised it, but I'd like to know more sort of about the downsides of deflation as well, because I know that's what's happening in Australia at the moment. We just had apparently our most deflationary quarter on record, and what exactly how does that all play out if we end up in a deflationary spiral instead? I don't want to go too far off topic, but yeah.
So I think look to the Great Depression. That's the kind of canonical example of a deflationary spiral. There's two kind of concerns with deflation. One is that your currency unit is no longer kind of this fixed frame of reference against which you can set all their prices in the economy, because it keeps increasing in value over time. So you're probably going to set your prices in something else. And then it's also going to be the case that people aren't going to want to spend their money. Typically money is the thing you spend, not the thing you save, or the money tokens are the things you spend, not the things you save. When you want to save, you buy an asset that's expected to provide a positive return, rather than just holding cash. You don't stuff cash in your mattress. If it's a deflationary scenario, then maybe you are stuffing cash in your mattress. Maybe some of these assets that you would ordinarily buy in order to save money, you don't trust them as much because it's harder to pay back a debt when your currency is in deflation. So you borrowed a certain amount and the person has to pay you back that amount, but that amount is suddenly a lot more. It's the same nominal amount, but it's a lot more. It's a lot harder to get that money to pay it back. So you might start hoarding cash in a deflationary scenario, and that's kind of what we saw in the Depression. People hoarding money. So the less you spend, that's kind of a self-reinforcing positive feedback loop as well. People are spending less, then everybody has to lower their prices more to get people to buy more, but then people, spend less. And there's also this factor that is there with a deflationary spiral that might not be there if you had a basic income, which is that when the businesses fail, because they can't sell their goods anymore at a reasonable price or something like that, they end up laying off people. People lose their jobs, they lose their incomes. So that squeezes the money flow as well. It squeezes consumer spending. if you have people getting money from a basic income, then you're interrupting that part of the cycle. And if the basic income is high enough, then you can pretty much stop it altogether. So if we'd had, so if we'd had a basic income in the 1930s, you know, we had all this capacity that just wasn't being activated because people didn't have enough spending power. If you ratchet up the basic income high enough, suddenly you can start activating all that capacity and people can start buying things again. And we don't necessarily care about the jobs, you know, the jobs are neither here nor there. But if you're activating capacity, people are going to get hired anyway as kind of a side effect. But you wouldn't be using the jobs as a way of getting people money, and you wouldn't be afraid of the job losses because people are losing their incomes because they're getting the money from the basic income. So the jobs are really just about activating the capacity that in the economy.
Sorry, I'll stop hogging the mic after this, but I'd just like to go over two things. One, if you could go back to sort of what happens now if the Fed raises rates and the stock market crashes. You know, does everyone flee to gold or stuff money in their mattresses, or like where does the money that is already in the stock market go, or does it just disappear because of the collapsing prices? And, you know, somebody sold those stocks, so that cash is somewhere, right? And the other thing I was going to suggest is, so this is one argument where I think a jobs guarantee has some edge a little bit over basic income, is this idea of preventing a deflationary spiral. Because especially if you've already got a basic income in place and then people lose jobs, right, then there's still a loss of income. Whereas if they lose the job and then they get another one at a in the public sector, then first of all their income will drop less, presumably, because they're transferring from one job to another, not transferring from a job to a basic income, or dropping out of a job and just having a basic income. And second of all, they're still going to be using they're still going to be sort of active and you know, buying cars to get to work and all of this sort of stuff. So the economy demobilizes less in the case of a jobs guarantee. I disagree with it for other reasons. So like, how would a basic income respond to that? Would you be when the I guess the CMT model is that, you know, when you're having a deflationary spiral, you increase the basic income to counteract that at the macro level. And so then I guess really my question is more about what do you think happens with the stock market if rates go up and, you know, what looks like a bubble to a lot of people pops.
So I think your intuition is right that the prices of the stocks crash, and then that's like that money is gone because we were measuring people's wealth in terms of stock valuations, and then the stock valuations crash. I don't think people are going to flee the dollar. If anything, that would correspond to the dollar getting stronger. That's, you know, deflation is the currency being able to buy more. So you've got the value of stocks will crash, but that means there's kind of people are less wealthy, so they're going to be potentially spending less. There's no reason to flee from the dollar in that situation. You know, I think in my ideal world, we would have a basic income and we'd keep increasing the basic income and allow monetary policy to tighten, allow the stock market to crash. And that's maybe not a bad thing. You're maybe wiping out part of the financial sector that didn't really need to be there, but you're ensuring that consumers are okay and the economy can reorient itself toward producing real goods and services for the benefit of ordinary people. Because right now you have a lot of this money in the financial sector that people just kind of spin around and invest in financial assets and that kind of thing. That's not necessarily, yeah. Go ahead.
Last question. The high price of gold at the moment, is that just like stocks? Is that just another thing that's getting pumped because there's loose money, or is that different?
It's a little bit different. A lot of times people go into gold when they're worried about the stock market, when they're worried that it might come down soon or something like that. Gold tends to be seen as a safer asset. I think a lot of the value of gold is psychology. You know, it's in terms of its intrinsic value, in terms of what you can use it for, it's basically worthless. But the fact that a lot of people believe in it causes it to be causes it to have a certain amount of value. It's similar to kind of Bitcoin and cryptocurrencies in that way. It's not anchored to anything in reality, unlike the dollar, which is actively managed and pegged to a basket of consumer goods to ensure the stability of the purchasing power. So I think there's a lot you can kind of read into the price of gold, that kind of thing, based on what people's psychology is and that kind of thing. But it's nothing fundamental to gold, and it's also not really something fundamental to what's going on in the economy or what's going on to the stock market. It has to do with people's interpretation of what's going on in the economy and then their psychology, and then they go and buy gold for whatever reason. Yeah.
So it's just like prehistoric Bitcoin.
Prehistoric Bitcoin. Yeah, exactly. I like that. Let's go to Dan.
Yeah, just a couple things related to what Austin was talking about. I think, too, the U.S. has kind of put itself in a bad situation by, on the one hand, we gave people money, which is sort of a basic income principle, but we funneled it through the unemployment system, which requires that you're unemployed in order to receive it. And so we have this tension now with trying to have people continue to receive the financial support, but also go back to work and not have a disincentive to not work. And it's like the compromise position is give people money and don't tie it to employment status, which would allow people to work when they feel safe to work. And then the economy it would seem like the economy could grow, and you wouldn't have, because we curbed the deflation fears initially by giving people money. People, at least for the last 4 months, people were able to stay in their homes, buy food, all those things. There weren't crazy, there wasn't crazy damage done on an individual level, but I think that without the continued support, that's likely to happen. And then again, if you don't have people able to be employed, if the productive capacity drops, that would also be a bad thing. So you want both, but I think we just painted ourselves into a corner. The original reason I had my hand up, though, was I wanted to ask about basic income in relation to hyperinflation. And is there a possibility, because I know Alex and Austin talk about a global basic income with I believe, a non-existing currency, like you wouldn't use the dollar, the euro, the yen, or anything like that. And so I was curious, if you introduced a global basic income in, say, dollars or euros, would that likely lead to hyperinflation in countries where their currency is very weak against the kind of, I guess, standard or reserve currencies of the world?
Yeah, so I guess the question is hyperinflation in terms of what currency? So if you're paying a basic income in terms of the dollar, by the way, I don't have any strong opinions about what currency the global basic income should be in. You could do it in the dollar, you could do it in the euro, you could do it in kind of a new currency. The question is what's most convenient. But certainly you would see prices start to even out around the world. I don't think you would trigger a hyperinflationary spiral. Certainly not in terms of the dollar, right? And then if people are getting the basic income in the dollar, maybe at first they're converting that into their local currency. Maybe they start pricing things in dollars in these countries. And then if something weird happens with the former local currency or the former domestic currency in that country, you don't really have to worry about that because everybody's getting dollars anyway. Would there be?
Or would you? I guess maybe in the long term, but it would seem like there would be a lot of short-term pain as people flee their current currency and move into dollars, like people who have less access to exchange, like the exchange markets and things like that.
Yeah, maybe. I think the exchange markets are generally pretty open in most places. I guess there's some places with capital controls and stuff like that. But my sense is that, first of all, you're going to ramp it up slowly. And second of all, most people, if they wanted to, they could switch into dollars right now if they really had the will to do it. So it's not, I don't have the sense that there would be that kind of this fundamental shift. It would just be that everybody's getting extra money, and many of them would probably convert it into their domestic currency in order to buy things locally, at least at first. I don't see there being a big disruption. Yeah.
Okay, cool.
Yeah. Go ahead, Eddie, if you're there. I kind of sneak up on Eddie sometimes. He has his hand up for a while and then he's not ready for me to call on him. So, so yeah, to kind of tie what we were just talking about back to Germany in the 1920s, I think it's true that if they if they hadn't cared about jobs as much, so this kind of relates to what Austin was saying as well about, the job guarantee. I think, you can, if your concern is that you want to ensure that people have enough money, you can increase the basic income. There is a concern that if people aren't working, then maybe you lose some of the production inputs and you lose some of the productive capacity. But if it's true that we were employing people in the first place as a way of getting them money, then you're just wasting people's time. You're keeping them busy. And I think that's true. That's very true in our economy. And I think it was also at least part of the motivation in Germany was that they wanted to make sure the workers were okay, make sure they were getting money. So if you're ever employing people for that reason, then you're not employing them because you want the output of the labor. So that's not efficient. So let's get to another quote from the article. As prices went up, the amounts of currency demanded were greater, and the German central bank responded to the demands. Yet the ruling authorities did not see anything wrong.
I was muted, wasn't I?
Oh, you're muted. I'll finish this quote, and then you can talk.
Okay. Yeah, I didn't realize I was muted. I was talking.
Sorry about that.
Go ahead.
Okay, yeah. So as prices went up, the amounts of currency demanded were greater, and the German central bank responded to the demands. Yet the ruling authorities did not see anything wrong. A leading financial newspaper said that the amounts of money in circulation were not excessively high. Dr. Rudolf Havenstein, the president of the Reichsbank, equivalent to the Federal Reserve, told an economics professor that he needed a new suit, but wasn't going to buy one until prices came down. So this could be reflective of what the central bankers actually believed, or it could be reflective of what they wanted the public to believe, right? So there's always what the central bank says they're doing and then what they're actually doing behind the scenes. And a lot of times what they say they're doing is a way of kind of pushing public sentiment in a direction. So I can imagine that if I'm a central banker and my currency is about to undergo hyperinflation or is starting to undergo hyperinflation, I might want to say to people, no, we don't have a hyperinflation problem, and project confidence that it's not a problem. Because if I say, oh my God, we have hyperinflation, that's only going to accelerate the hyperinflation. So I wouldn't necessarily say that this guy was clueless, but it could also partly be a product of the message he needed to send to the people. So that's it. Go ahead, Eddie.
So I guess responding to Austin a bit, I would argue that there is some danger of a dollar devaluation in the current situation. And if you think about it, to start off with, like I talked about a little bit last week, the fact that you have these depressions, the fact that when you compare 1800 to 1920 and to 2020, we're 50 times richer in terms of how much we're producing than we were 220 years ago. And yet, when we go into a depression like we're kind of going into right now, we still get the situation where large portions of the population are struggling to pay for food and pay for rent. And that's a really odd thing. And the reason that happens, I would argue, is that economists are not completely clear about the mechanism of it. And so if you look at the stimulus that we currently do with monetary and fiscal policy, the money goes either to businesses through the debt markets and the financial sector, or to governments. And so what we've done is that, in the last Great Depression, those two things were actually some kind of invented. Like, we kind of started monetary policy and fiscal policy during the last Great Depression. So, since 2008, we've been using both of those, and we've been using those, in extreme amounts. With the near zero, monetary policy, with the trillions in quantitative easing, and with the trillions in government deficits. We're pushing both of those levers all out. And yet we're still going into a depression. And I would argue that's exactly what you would expect if you understand the situation correctly, because the problem is that the bottom layer of society, the workers and the consumers, are the ones being deflated. They're losing income because their labor is not as necessary due to productivity growth. And so what you have is a wrong shaped economy where you have too much money at the top and it's not getting to the bottom. And what you need to do with the basic income is get the money directly to the bottom, so that people, so that everybody has money to spend. Because the wealthy is only 1% of society, and they can't consume for everybody. And so the danger here is that when you put rates down to zero and you do trillions of quantitative easing, and you're buying bonds from corporations and whatnot, those interest rates go all across the financial sector. Every thing in the financial sector is connected to everything else, such as gold, stocks, and bonds. For example, stock on the stock market, the fundamental way to evaluate a stock is using a discount that you compare the earnings of the company to what you would make if you put that money into a bond instead. And so, normal times, if the bond is 5%, but you get down to 1% or 0.5%, which is where it is near that makes those cash flows that are way out in the future up to 10 times more valuable in a 0.5% discount rate market versus in a 5% discount rate market. So what you're doing when you do that much monetary policy is that you're pushing money out into the entire capital financial sector. So it starts in the debt markets from the Federal Reserve, hot off the press. Federal Reserve pushes a button, creates money to buy bonds with, but that actually spreads out through the entire thing, and so it goes into stocks and sends stocks higher through the discount rate. It goes into other things. And one of the interesting things, as Austin's kind of pointing out, is that right now you have a very unique situation where you have the stocks going up, and you have the gold going up. And the danger really is that while the bottom of the economy is not getting enough money, you're pushing too much into the top, and sooner or later, it gets to the point where the stock market, that's the earnings in the company are ridiculous. So the earnings are really low. You can't earn money in stocks. There's no income holding up the stocks. There's not enough income holding up the bonds. And eventually, and especially with the bonds, you end up with gosh, there's so much. There's even more to say here. You end up with a sort of a valuation bubble, and you push the valuations up, and you push the earnings down as a ratio to the value, until it gets where it's almost ridiculous. The earnings are really, really low, valuations are really high, and at that point, for investors, it makes no sense to be in bonds, or it makes no sense to be in stocks for the earnings per se, right. Although it might be an inflation hedge, and as a result, they flee the bonds, they flee the dollar, they go into gold, and you just end up with the bubble bursting with everything going into gold, and it can also crash the dollar at the same.
So let me try to sum up everything you just said, or some parts of it. So you're seeing stocks as being overvalued and becoming increasingly overvalued compared to the earnings of the companies that their shares in. And I think that's probably accurate. And then maybe bond prices are getting so high and the yields are getting so low on those bonds, because for people who aren't familiar, a bond is just an IOU, and it says I owe you $100 in 5 years, but you buy it for like $95, so then you get the $5, and that's your interest rate. But if you buy it for $99, a higher price, that's a lower interest rate, a lower yield. So
Yeah.
if bond yields are
The-
higher, then if prices are lower, and if prices are higher, then the yields are lower. So the idea is that if
the
bond
bond
go ahead.
they're really fundamental to the picture because
Right.
You know, when the interest rates go down on bonds, and that's the market rates going down, you have this enormous quantity of bonds that already exist, so they're existing at a higher interest rate.
Yeah.
So
I just kind of want to wrap up,
Yeah.
and then yeah. So the idea is, part of the problem here is that, you know, the bonds are so expensive and the yields are so low that people are reaching for yields, and they're shifting into buying stocks because that's where they're going to get a greater return. This pumps up the stock prices even more. And then you've got, because yields are so low, because interest rates are so low, it gets really easy to borrow. So you can borrow to buy even more assets, to buy more bonds and more stocks and all of that. And then this gets more and more brittle and forms a bubble and can collapse. I think all of that is right, in terms of what Eddie just said. Something that I disagree with that you said, Eddie, is that you said both our monetary policy lever and our fiscal policy lever are all out. So certainly monetary policy is being pushed very, very far. Interest rates are smack at zero. We've eliminated reserve requirements. We've done all this quantitative easing, you know, all of that kind of stuff. You guys don't need to know what all that stuff means, but it basically means in the economy, we're making it really, really easy for people to borrow money. We're trying to push money out into the economy through the financial sector. That's what monetary policy is. And it's gone really far in that direction. I would argue that we have a lot of room on the fiscal policy side, that the government can spend a lot more. And if they did, that allows monetary policy to tighten. So one of the main ways that you can do that you can provide stimulus from the fiscal side of things is, I mean, not the main ways we have done it, but one of the main ways you could do it is to pay out a basic income that's higher and higher and higher, and allows the Fed to tighten, allows monetary policy to tighten. Now, this, of course, brings about the crash that Eddie was talking about, because everybody's depending on that cheap borrowing to be able to continue, you know, the bubble on its way. So the bubble pops, but maybe you're okay because you have a basic income, and most people's incomes, at least especially the ordinary consumers, is being backstopped in this way. Now the question is, would everybody flee the dollar and go buy gold? I'm not sold on that point, but maybe we could talk about it a little bit more. But first, I want to get to Bethany, because you've had your hand up for a little while.
If just
ahead,
really
Eddie.
quick. So I do agree that the basic income solves everything, and in fact, it solves the whole thing, because when you start putting the basic income out and putting the money into the bottom of the economy, that goes into the earnings. And so part of the problem is that companies can't make money because consumers don't have money to spend. So when you do the basic income, the earnings actually come back, and so the stocks actually do not have to pop.
Well, I think it's a bit different, because if the people with the money are ordinary consumers, then the types of businesses that are going to be able to earn money are going to be different than the types of businesses that earn a lot of money today. So there's still a little bit of a disruption there. But I think it does reorient our businesses to be working more in the interest of the people, because if the people are the ones who have the money, then that's where the profit is. So businesses that are already more consumer oriented will benefit, and then businesses will benefit from shifting to be more consumer oriented, and then businesses that are providing services to other businesses that are providing services to other businesses that are providing services to people who've borrowed a lot of money or something like that. All these businesses borrowed a lot of money and are providing services to each other. Maybe that part of the economy collapses still. So yeah, but I think you're right, of course, that you can have a healthy financial sector if you have a basic income. It just might be a little bit of a rough road transitioning from the financial sector we have now to a healthier financial sector. Let's go to Bethany.
Hey, this is from a while ago, but you were talking about a basic income in Weimar Germany and whether that would solve things. Yeah. And I guess I was still thinking maybe it wouldn't be enough, given what you were saying before. If the reparations were going to be so bad that they had to hit rock bottom before they were like let up on, then it seems like, well, maybe it would help. Maybe you could have a rock bottom that was like a little less bad, but it kind of seems like that is a situation where basic income might help a bit, but if they're basically being forced to hit rock bottom, they're being forced to hit rock bottom, and like no amount of good policy can get around that. I don't know if that was really the situation, but that was a comment that I had on that.
Yeah, I mean, I think, could it have been smoother? Maybe. I think if you have a basic income, then it's more true that all of your citizens are kind of in the same boat, rather than having the situation where maybe there's some rich people who were invested in the stock market or were able to get some of their money out and buy some other, real assets or something like that. It's more everybody's in it together type situation. So that might have helped. But I still feel like Germany would have had to have been pushed to the brink by France before it really turned around. Yeah. Let's go to Austin.
Hey guys, sorry, I just had to unmute my mic. I wanted to sort of jump back to, I'm sorry to drag us further from Weimar Germany. There's just so much going on at the moment that there's a lot to think about there as well. What Eddie and you were discussing, and 2 points on that. One is, you mentioned that it's easy for people to borrow money with, loose monetary policy. I think it's important to say it's possible for certain people to borrow money.
Yeah,
so if you
right.
have assets, so this is a thing where how money, as Eddie puts it, comes in at the top of the economy, and this is where I think you and I have a slight difference. And I think that you're a bit of an inequality dove, and I'm a bit of an inequality hawk. I think inequality is sort of more inherently detrimental, apart from just like in a moral way, even in an economic way, because as you described, like what is the economy geared towards, right? And it's geared towards at the moment producing services for businesses and so on, and it's also geared towards producing luxury goods over mass consumer goods. And in a sense, there becomes a point where you've already given everybody gold toilets and caviar stuffed swan or whatever, right? Like there's nothing else for rich people to buy except more financial instruments and more assets. And so the product that these companies makes becomes stocks, right? Like, we don't actually sell, widgets. What we do is we sell, it's, obviously there's still a formal difference, but like what happens is, like a lot of, especially I think in the tech sector, you see, like the WeWork unicorns, which have no real product, they rent some real estate and then they sublet at the end and they have this tiny amount of real estate and these massive valuations. And people are buying in not because they think they're going to get great returns, but because it's like this theory of the greater fool, except there always does seem to be a greater fool so long as the interest rates are really low. So we kind of have this sort of wild explosion of wealth at the top. And so long as there's the threat of, the threat of deflation, they're just going to keep cranking that. And I just kind of don't really know where that ends. And I think this is why, like you have to kind of look at it through the lens of inequality, and the basic income as a leveling tool, not just as a sort of stimulatory tool, which I don't think there's that much conflict in the way we think about it, but I think there's just maybe it's more about the language. But the other thing was that I shared an article in the CMT Reddit that I came across, which was really interesting, which was this idea that someone's actually looked at the 70 biggest economies in the world over the last 40 years and said, creating money doesn't cause inflation. Expanding the monetary supply, the Fed buying, the Reserve Bank buying financial assets, all these things that we're told will cause hyperinflation don't, right? Because we can just look at the historical record. And my initial position was maybe this is a bit like the braking causes accidents argument, right? Because if you look at the historic record, car crashes are preceded 90% of the time by someone slamming on the brakes. So if no one slams on the brakes, there's never going to be a crash, right? So because people are facing deflationary pressures, that's when they increase the money supply, and that's why you're not seeing inflation. What you're misunderstanding is people are getting the causality backwards, where the cause is actually in the future. It's the threat of deflation, or there's something that's about to happen, so people react in advance, and then it's easy to make a causal argument because of the sequence, right? But I think Eddie convinced me that no, the article's actually right, what happens because of the way we inflate the money supply is by giving it to people who can't really spend it. They can't go out and buy a billion hamburgers and eat them all, right? They can't go out and buy a billion bicycles or whatever. So that it's not this is an argument for the income theory versus the supply theory of money, I guess. And I'm just sort of thinking all that through.
Yeah, I mean, I think you're right about the breaking causes accidents thing. Certainly, a lot of the times when we print money, we're doing that because that's what's appropriate for the economy. So of course, it's not going to cause hyperinflation. In the times when you see hyperinflation, that's when, I said this at the beginning, but it's when a government has committed itself to spending more money or committing itself to spending money to activate more real productive capacity, buy more real goods, real stuff than the economy can actually sustain. So a simple way I said this at the beginning too, a simple way to cause hyperinflation with a basic income is to say, okay, we want to set the basic income to a level that's higher than what the economy can sustain, that puts consumer purchasing power at a level where they're able to buy more stuff than the economy can produce. And not only that, but we're committing to indexing that basic income to inflation. So as the prices go up, we increase the basic income to match. Then you have a hyperinflationary spiral. So certainly you can cause hyperinflation by making this kind of commitment. And a lot of times, when it really happens in real life is when governments are forced to make this commitment from outsiders. So as we saw in Weimar Germany, as we saw in Argentina, Venezuela, places that have external debt that they have to pay, that kind of thing.
I think a really interesting example right now is, like I've mentioned a couple of times, but it just got a whole bunch more serious, is Lebanon, where I'm not sure how much of what was the inflation was going on before was just a political crisis and sort of incompetence. There was real shortages, like that people were bringing in the wrong, because of corruption, people bought the wrong kind of fuel oil, and there was shortages of petrol and blah, blah, blah. And now what's happened is the port has blown up. Like literally the main port where stuff comes into the country has blown up. The grain silo has blown up. And on top of that, you're almost definitely going to see a massive political crisis. So I think it's going to be a really tragic situation unfolding in Lebanon over the next, weeks and months, where you're probably going to see like ridiculous, stupid hyperinflation, and the dollar will become the actual currency people use, and the local currency will be worthless, but people can't get dollars. So you get like deflation in dollars, inflation in the local currency, everything's out of whack, and chaos, violence, hell on earth.
Yeah. That'll be interesting to see how that unfolds there. I wanted to get back to a comment that Jake had made at the beginning about the United States dollar being the world reserve currency, and whether you could really have hyperinflation if you're the world reserve currency. And I think the answer is both yes and no, in the sense that if you start to mismanage the currency, then you're not going to be the world reserve currency anymore. And that'll probably happen before you get to the level of hyperinflation. Yeah, so that's kind of the answer to that question. In order to be the world reserve currency, the currency has to be managed properly. It has to be kept stable. So that's kind of how we earn and keep that position as the world reserve currency. Does that make sense, Jake?
Yeah, I mean, sort of. I mean, so it sort of does. I've been thinking about like this analogy. So this is throwing from left field, like a little analogy around like the reasons to get married are different from the reasons to like stay married. I think that like the stuff that like makes the currency become the reserve currency is different than the stuff that makes it stay the reserve currency. So like it's just hard to see, because like I've only existed like where the US dollar has been the reserve currency, but like how would like the steps play out, you think, where like we don't, would it just like, I don't know, I really have trouble. Like part of me is like, you know what, maybe we can just do whatever the heck we want monetary policy wise. Like we can do no wrong. Like we owe people, that whole phrase about like, if you owe the bank $100, the bank owns you. If you owe the bank $100 million, you own the bank. Like we kind of own the world. because we owe a bunch of people money or whatever. We just, I don't know. It's just, I'm like, part of me, like, you know, my gut tells me like, yeah, we can't just do whatever we want, but I don't really see like mismanagement getting punished.
Yeah, I mean, I think all of your intuitions are right. I think there's a lot more of kind of a barrier to being, you know, kind of replaced as the world reserve currency than, you know, there is to kind of maintaining your position as world. Like, we could mess up a lot and still be the world reserve currency. But there's a limit to how far you can go. And this is true kind of at the level of an individual country as well. So if you look at a hyperinflation like Weimar Germany, people were still using the German mark as their currency, even after it started to be like not the optimal thing to use as their currency. It really took a lot for people to start like bringing in dollars and trying to get out of the currency and that kind of stuff. So I think that's true if you're thinking about the world reserve currency as well, maybe even to a greater extent. But you know, what you'd probably, if you're looking at the process for how that transition would happen, you could start to, I mean, first you could think about the pound sterling, which used to kind of be the world reserve currency. Everyone was pegged to gold, so maybe gold was the world reserve currency at that point, depending on how you want to look at it. But you know, England had all these external drains due to war, and then they lost, you know, their peg to gold, and the United States ended up in a stronger position with all the world's gold and, you know, that kind of thing. So they kind of settled into the world reserve currency. And it wasn't like there wasn't a massive collapse of the pound or something like that. It wasn't some disaster. It was just kind of a, you know, a transition, right? And you can imagine that happening with the dollar as well. You know, if there's someone who's got a really great currency, maybe they pay out a basic income. So everyone's getting income in this currency anyway, or something like that. And it's really stable. And, you know, maybe the dollar isn't being managed well and it becomes a little bit less stable. So you've got people, you know, it's a gradual thing. People might start saying, oh, I want to buy some sovereign debt that's safe. I'm not going to buy US debt this time. I'm going to buy this other one that seems like it's a pretty good deal. And, you know, people, you know, all the central banks and all the different investors and everything, they hold portfolios of different currencies. So you'd see a gradual rebalancing kind of away from the dollar, where, and then it eventually gets to the point where more and more international prices are being denominated in this new currency. So right now you could look at, you know, the euro and the yen as potential contenders for that kind of thing. But you know, there is a lot of, as you said, there's a lot of US debt out there that's just kind of out there. So we'd have to figure out, you know, if everybody wants to sell that, that drives up interest rates on that debt, and it drives up interest rates that people are going to be able to get in the dollar. So that kind of counterbalances the pressures a little bit, because it tightens the dollar and helps strengthen it a little bit. But I think you could see a transition without it being a disaster for the dollar, without it being kind of a collapse or something like that. Yeah. Obviously, if you do enough to cause hyperinflation, then that's a kind of collapse. But you know, we could lose our world reserve currency without doing hyperinflationary policies, I think, if we're just not managing it well. So I want to get to another quote before I get to the people who have their hands up. Okay, so here we go. Like this one. The publisher Leopold Ulstein wrote, "People just didn't understand what was happening. All the economic theory they had been taught didn't provide for the phenomenon. There was a feeling of utter dependence on anonymous powers, almost as a primitive people believed in magic, that somebody must be in the know, that the small group of somebodies must be a conspiracy," or something like that. So I think this kind of feeds into kind of the anti-Semitic, you know, kind of banking conspiracies. You know, central banks are, you know, out to get us, and the financiers are out to get us, that kind of thing. And you know, people when they're afraid and there's something they don't understand, they like to assign some kind of agency to their circumstances. Someone is causing this, someone is doing this to me, that kind of thing. And maybe to some extent there were mistakes that were made that caused that to happen. You know, maybe they should have been blaming their government for losing World War I or something like that. But you know, we see this kind of stuff, and it's really hard to, we can look back in time and say, oh, Germany printed a ton of money, therefore hyperinflation, but it's not quite that simple. And I think it was also true that during World War I, especially, the German public was kind of cut off from knowing about what was happening in the world with currencies and stuff like that. They didn't know necessarily until after World War I was over that prices were twice as high as they were before World War I and stuff like that. So there's, the people don't really know what's going on, and the average person is maybe not thinking about central bank policy and that kind of thing. I guess the reparations thing was a very kind of public thing that was in all the newspapers and that kind of thing. So there's certainly a lot of people blaming France and all of that. Let's go to Eddie.
So I think one really important thing to distinguish here is, kind of two types of inflation. So one type is capacity constrained inflation, which is sort of what you saw in the 70s. And the mechanism for that inflation is that you have, too much money chasing too few goods. So you're pushing up against the production capacity of the economy, and yet consumer incomes are still rising, and so people try to spend more money, but the economy actually cannot produce more production at that moment in time, and so you end up having the prices go up instead. That's one type. And the hyperinflation is completely different from that. It's a completely different mechanism, and the mechanism of the hyperinflation is basically a bank run on the currency issuer. And so, if you look at what happened in Weimar Germany, subsequent to as World War I is going on and Germany begins to look like it's losing, at that point in time, you end up with a future that's changing from one where Germany wins and they get indemnity, they get war indemnities, they get to take a lot of money from the losers, to one where they are the loser and they're going to have to pay lots and lots of money to everybody else. And what happens as that future comes into play is that the wealthy in Germany, they're looking at this and they're not dumb. They're like they're looking at the government finances and saying those finances are not going to work. I don't think the government is going to be able to have enough money to pay those reparations. And so what is the government going to do? Well, the rich people, the wealthy, they have money, so they realize they know and they were correct. That is what actually happened. That the government, when they can't pay their war reparations, they turn around and start taxing the wealthy very heavily, even towards like confiscation. Tax rates up to 90%, and you have wealth taxes, whatnot. The government, when it doesn't have money, it's going to start looking at the wealthy. So the wealthy, kind of game theory, they see that, and so they are in a rush to get their money, their capital, all of their assets, all of their wealth out of the country in whatever form that they can, in order to avoid having it being taken by the government. So you end up with a run, an exit from the currency. Another way to think about it, and so with the bank run dynamics, with the bank run, even if you have a completely healthy bank, it's completely normal if everybody goes to try to withdraw their deposits on the same day. The bank does not have that money to hand them. And so the currency generally runs because people are getting in and out, constantly. You buy something, you're out of the goods. You make your paycheck, you're back in the money. You buy you buy something, you import, you export. People are in and out. It's just a flow. It works. But as soon as you get a situation where everybody is worrying about something. So the wealthy started with worrying about the government is going to take their goods, but it can also be, in the current situation of dangers, everybody there, significant parts of the financial community There's a lot of people who are bullish on gold right now and bearish on the dollar. And so as soon as you get, everybody saying, I'm worried about the dollar, I want to get out of it, that puts a lot of pressure on the dollar to decline, which scares people more, and it becomes a positive feedback loop where it goes down more and then people get out more. The world reserve currency thing, I think that is actually another risk factor for us, because what that means is that you have central banks around the world who hold US dollars, and the only reason they hold US dollars is because it's considered a safe, secure, valuable store of wealth, of value. They can use it to support their own currency. But in the case that they are worrying, and they are worrying, and you can see that China and Japan are getting out of the US dollar slowly. They know to do it very slowly because they have very, very large amounts. And so to the degree that they are also the world, the central banks of the world, they are also wary of this. They also don't want to have their media, telling people, look, the central bank was so stupid. They had, billions of dollars of US dollars, and now the US dollar is crashing.
Well, they don't want to. They don't want to make their own assets worthless. I mean, I think you're bringing up a good point about
their source of supply.
Yeah, I think you're bringing up a good point about currency runs. That even if a currency is being managed properly, you could end up in this situation where people's psychology is self-reinforcing, and it just brings the whole currency down. Maybe with a bank, I feel like you can have more of that effect, because a lot of times there's not much the bank can do to prevent it. With a country like the United States, if there's ever a run on the dollar or something like that, we kind of know how to push back against that. We know how to tighten monetary policy. Could it ever get to a point where the dollar just collapses? If we wanted to, we could let that happen, but I don't think we're gonna let that happen, if that makes any sense. I feel like a lot of times with a run on the bank really there's nothing they can do, right? And a lot of times it's kind of correlated with other runs on other banks and kind of the general state of the economy. With a currency, especially the size of the United States, they could, if they wanted to, allow the currency to collapse. But there's a lot of tools they have in their basket. Like, they are so far in the direction of monetary stimulus, of expansionary monetary policy, that they have plenty of room to pull back from that. And they don't even have to do it all at once. If they start seeing pressure, they can do it a little bit. So they would really have to make a decision to allow the currency to collapse in order for it to collapse. I don't feel like there's this thing that can just kind of get out of control all on its own. I'm skeptical of that.
So the danger is that, if you can see it, there's a danger that it happens right now at around this point in time. And so, if the dollar starts collapsing, 6 months or a year to now, and the economy is still in the dumps, terrible unemployment, the thing is that the central bank is going to be in a bind. On the one hand, they're supposed to keep rates low. They're supposed to support the economy, so that to support, to try to keep unemployment from rising too much. And on the other hand, the thing that they would do to support the dollar and prevent the dollar from crashing is to raise rates, or even to withdrawing fiscal policy, austerity. Spending less. The government spending less is what you're supposed to do to support the currency. And so that's why you end up with both risks of deflation and risks of inflation when you get to depressionary conditions, because you have those two things and they're literally jammed up against each other, and it's Skilla and Charybdis. You gotta choose one. But again, basic income solves it, because
exactly.
Send the money to the bottom, then that actually supports the economy, makes it grow again, and that actually grows tax revenues. It just it actually fixes everything. So basic income is actually the answer. It is not. We need to do that, or we're going to have Skilla Richard?
Well, I certainly agree with you that basic income is the answer. It allows us to tighten monetary policy without it being too painful to our people. So it
Exactly.
takes away, it takes away this kind of tension of like, oh no, we need to defend the dollar, but we don't want to hurt our people kind of thing. You can actually defend the dollar and not hurt the people at the same time. I think that's right. Maybe I'm a little bit less pessimistic than you are that even without basic income, we would that this kind of potential explosion is going to happen. I really don't I don't see it happening, but I get where you're getting at. I see that tension there, and that tension kind of played itself out a little bit in Weimar Germany too. They wanted to pay all the workers, keep the workers employed, and at the same time, they couldn't defend their currency. So it's a real thing. I don't know. I'll if it happens, that would be unfortunate. I hope for both of our sakes that we never have to find out whether it would happen, because we all just adopt a basic income and then everything's okay. So I'm going to get to the last two quotes from the article, and then I'll go around and get people's final thoughts. I know people have their hands up, so we'll get to you guys in final thoughts. Let's see here. I'm just going to read these two quotes. They're actually adjacent to each other. Obviously, though the currency was worthless, Germany was still a rich country with mines, farms, factories, forests. The backing for the Rentenmark this is the currency that they introduced to provide a new stable currency to replace the inflating mark. The backing for the Rentenmark was mortgages on the land and bonds on the factories, but that backing was a fiction. The factories and land couldn't be turned into cash used abroad. 9 zeros were struck from the currency. That is, 1 Rentenmark was equal to 1 billion old marks. The Germans wanted desperately to believe in the Rentenmark, so they did. I remember, said one Frau Barton of East Prussia, the feeling of having just 1 Rentenmark to spend. I bought a small tin bread bin just to buy something that had a price tag for 1 mark was so exciting. And then the next paragraph is this: all money is a matter of belief. Credit derives from Latin credere, to believe. Belief was there, the factories functioned, the farmers delivered their produce, the central bank kept the belief alive when it would not let even the government borrow further. So I'm not going to go so far as to say all money is a matter of belief. I'm going to say that money is backed by promises. So what happened is that the central bank made a credible promise, or the government made the central bank made a credible promise not to lend to the government and to keep the currency stable. But promises are not nothing, right? Money isn't out of thin air. Money is backed by a promise of stability, and that's why we use it as money. So I think he's going a little bit overboard, and it's just like, oh, it's a matter of psychology or something like that. No, there was a real commitment that had to be made. So let's go around and get people's final thoughts. We'll go Martin, and then Richard, and then Jake.
So I'm Googling a way to find exactly the date of the Reagan speech that around 1985-ish or so signaled a change in policy that I think in sort of the public view, or Reagan's words were to no longer support the dollar, but to the effect of not artificially supporting the dollar. And unfortunately, I didn't get the exact speech, and I've got the New York Times article from about 1985 talking about this. But the point is that what Reagan said, the dollar versus the Deutschmark, the dollar practically collapsed. And I remember it because when you're in the military and you live in Germany, you're just watching the exchange rate every day because it's just like a sport, I don't know, pastime. You're paid in dollars and you can buy stuff in Deutschmark. And I actually bought a brand new 1985 K100 BMW motorcycle at a remarkably low price because of the strength of the exchange rate. And either wisely or foolishly, I missed the best exchange rate by about $500 on the cost of the motorcycle. But what I had done is I'd set my own benchmark for when I would make the exchange. The dollar got to my benchmark. I exchanged the dollars into sufficient Deutschmarks. And I didn't buy the motorbike right away because it was getting near the end of the season. And I didn't want to have to like try to store it by getting it delivered in the middle of the winter. Anyway, the whole point is this sort of psychology, and you know, we've sort of talked a lot here, and I suppose I'll just sort of leave it as an open thought, open question as I listen to everything that everyone said. This sort of element of uncertainty. Do we really know what happens when we make these very significant or seemingly very significant changes to how the economy functions, like in the nature of a basic income? And my feeling, and some a little bit older, is to have a ton of humility when trying to guess how any of these things could go.
Okay, thanks, Martin. We'll go to Richard, Jake, and then Bethany.
Well, the way I see it is that Weimar, I mean, like fascist Germany, and well, how the US is right now, it could easily become well, some sort of fascist government, because we let our infrastructure get to like D levels according to the Army Corps of Engineers and things, and we're making major military investments, like 10 times what the rest of the next 10 countries combined or something like that. No, more than the next 10 countries, whatever it is. And so that's how Germany got out of the whole Weimar collapse. They spent a ton on military investments and in infrastructure. And well, we have horrible infrastructure, and we could easily spend more on, well, military investments. So there's just such a parallel now. But with Trump all screwing up and stuff with COVID, there might be a way around that.
Okay, thanks, Richard. Let's go to Jake, Bethany, and then Dan.
This is just awesome. Thanks for including me, guys. This hasn't been, I don't really have anything like I don't think at this point. Just give me a lot to think about. I mean, the cool thing is that like, we're gonna just build this new thing. It's not like there's no like God coming down to like give us this new system. It's like, nah, man, like people who care are gonna invent some new system. So it's cool to take this stuff seriously. So I'll just I don't know, just a lot to think about more than anything to like say. But yeah, I'll pass the mic.
Thanks, Jake. Let's go to Bethany, Dan, and then Austin.
Yeah, great discussion. One thing that stood out to me from the article was in one of your later quotes that that people sort of thought there was some kind of conspiracy. I knew that the hyperinflation was sort of led to dissatisfaction, helped the Nazis get into power, but like I didn't realize that there was such a direct connection with people somehow imagining that things could only have gone so wrong with like a cabal of people planning it to go wrong. I just found that's an interesting aspect of psychology with these kinds of things that I hadn't thought about. And then the other thing is the belief thing that you mentioned. I noticed in the article that he seemed to suggest that people believed in the mark for quite a while, but even as it was going south. So that seemed kind of like inconsistent with his point later that the replacement worked because people believed in it. So I appreciate you kind of clarifying the other mechanisms behind how that actually worked. It seems like they actually kept it more stable and they were forgiven like some of their reparations and things like that. So that was sort of how they got out of it.
Yeah, and I think that's why it's more than just belief, right? The institutions have to be making credible promise. So yeah, it's and it's true that they believed in the original paper mark for a long time before it flipped over into hyperinflation. But I think around the time it flipped over into hyperinflation was around the time they kind of stopped believing in it altogether. So the belief was kind of holding it back from being worse than it was for a while. Yeah. And at the end, just to kind of clarify for everyone, the reparations that Germany owed were restructured, and they never ended up having to pay back all of that debt. And even once the Rentenmark was introduced, they looked at people's debts from beforehand, and they reconstituted some of them at like 25% instead of like 1 in a billion or something like that. So they were able to recover some of people's, some portion of people's financial wealth from beforehand. They weren't just letting all that ride. So let's go to Dan, and then Austin, and then Eddie.
Yeah, so another great discussion. One of the points I wanted to raise, but we didn't get enough time, was just thinking about if there are good examples of hyperinflation. And I was thinking potentially with wages, and in the sense that a basic income would probably lead to higher wages. And if that was in a hyperinflationary sort of scenario, would that be good or bad? Because with raising the minimum wage arbitrarily from like say $7.25 to $15, that would fit the bill of wages being hyperinflated, at the bottom, because you're increasing them by, it's like over 100%. But more people there would be less hiring, and so how would that affect people, as opposed to if wages rise because there's a basic income, and so even if wages rise very quickly, there's less of an impact to people in the economy and personally. So that was something, but we didn't get any time to talk about it. But yeah, another great discussion. Thanks.
Yeah, so I think hyperinflation is more a property of the currency itself and the general price level than it is a property of kind of individual prices in the economy. But it's still an interesting question, how doubling everyone's wages really fast would affect things. I think that's something worth exploring too. Let's go to Austin, and then Eddie.
Yeah, guys, great discussion as always. I wanted to, as a final thought, go back to a little bit of what Eddie was saying. And I think that there's really something to his concern about how, I guess you could, just to put it in a sort of really simple way, it's like the functioning of the dollar as a national currency and the functioning of the dollar as a global world, as a world reserve currency aren't both the central bank and the national government in this sort of position where the interests diverge, like what you would do to manage it, to maintain it as a world currency, and what you want to do to stimulate the local economy may diverge. And that's a really interesting and a sort of unstable dynamic, and that he should write a blog about that, because I'd like to sort of read what he says, read what he, his sort of long form version of that. But I also wanted to add that, like, when we were talking about the British Empire, the British pound losing its place as world currency, what we didn't discuss with that was the fall of the British Empire, and I think it's almost like how MMT say, money is really based on the like Warren Mosler and MMT say money is based on the government's capacity to use violence, more or less. So we demand taxes in currency, and we put a gun to your head and we make you pay it. And there is a sort of a version of that happening with the global economy. Like, the British, before the Second World War, controlled the Suez Canal, which is this, major shipping route. And after the Second World War, the Americans took it over, right? And so what's this? I don't think you can have this sort of benign view of the U.S. currency as a global reserve, as unconnected to military power. And I think Weimar Germany also shows, it sort of hints at that, like, you lose the war, your currency loses value. It's about that there is a relationship between, coercive power and a currency, and that puts the US in a precarious position. Like someone mentioned, it puts the world in a precarious position. And someone mentioned the fact that Saudi Arabia sells, its oil in US dollars. Well, that's dependent on the US military's ability to dominate and control the Persian Gulf. This is, and the Red Sea and the Suez Canal and all the sort of important shipping ways for that oil to get out, right? So I think that's another sort of destabilizing factor, and another problem with having any national currency as the world reserve, and that national currency has historically been, I think, for a reason, the currency of the most powerful military nation at the time, or at least the perceived most powerful military nation. So maybe the British had actually lost that position before sort of the monetary system caught up. And that, of course, and the British Empire was what Germany was challenging in the First World War, and their control of shipping routes and so on. So I just feel like that element probably, Weimar Germany should be pointing us in this direction, that we're looking at the link between military power and currency, and that is another reason that we should be thinking to move to a global reserve that's not the US dollar and not just some other country, because then it's going to be, a fight for it.
All right. Well, that certainly is fodder for another 2 hours of discussion right there. Let's go to Eddie. Final thoughts.
So I wanted to thank Alex for having this discussion, because he knows this is my favorite topic. And I was very sad that I wasn't able to make it on time today. I want to thank Austin because I will promise to write an article about this, because I've been trying to motivate myself to write something and been having a little struggle with that lately. And I really love what Martin said about being humble and not really knowing where things are going. I think that's really true. I think right now, the state of economics right now, most economists don't really know where we're going, and we should. And I think what's really key to that is that the economy is a complex, dynamical system. It's similar to like the predator-prey cycle, or similar to the three-body problem, where you have all these different variables. They all affect each other, and their changes and rate of changes affect each other. And you end up with all these positive feedback loops inside the system, and also negative feedback loops, and limits inside the system, constraints inside the system. So you end up with, you never know precisely what's going to happen. It's impossible to know exactly what's going to happen with precision because of chaos theory, because of the butterfly effect. But there are, if you understand it well enough, then you should be able to trace out pathways. Like, these are different potential pathways, orbits, or equilibriums that we can move into. And so I think that is where economics needs to go.
All right, those are some good final thoughts. Caleb on the live stream is going to finish us off with a question. He said, could there be scenarios where rapid sustained inflation could be negligible, I think in terms of the effects on the economy, if wages and other incentives were also able to keep pace with the inflation of the cost of other goods? And I'm going to say no. In order for the currency to function properly, it needs to be a stable standard of value. You have to know what a dollar is worth. It has to buy the same amount of stuff tomorrow as it did today in order for it to be used as our standard pricing unit. So you can't really have a hyperinflating currency that's functional. The market will find something else to use as its standard of value. So that's it for today. Next week, we're going to be talking about the concept of post-scarcity and how that relates to the idea of basic income. Thanks, guys.
Thanks, everyone.
Thanks, Alex.
Alex.